Hello everyone and welcome to my channel. In this video, we're going to talk about one of the more interesting or intriguing EV companies that has been trading on a Nasdaq, Canoo Inc., trading under the ticker symbol GOEV or GOEV. It was one of the 2020 era's rising stars back then, when the EV seemed to be on the verge of taking over. Now, this is not how things have played out, and nowadays people are wondering whether there's any sort of possibility to see Canoo back to where it was. In this video, we're going to talk about Canoo, the recent price actions, the technicals, and what is the best trading approach given the circumstances. Before the video continues, if you would like to see more stock analysis videos like this one, please remember to comment, like, and to subscribe to my channel. So Canoo is currently trading around like 20 to 21 cents level with a 9% decrease over the past 5 days, 15 if you look at the last month, and 57% drop over the past 6 months. So the current point is probably like the lowest point for Canoo historically, with no sustained lower levels observed so far. The company has gone through significant transformations, that's for sure, moving from a R&D phase, or I want to say like an advertisement only phase, to the operational phase, where they're now expected to come up with production and also sales. The critical question for investors is whether Canoo stock is a wise choice for 2024, given that in the past few years, its value declined by like 99%. Canoo has entered into the revenue generation phase, or so it claims, and it's accelerating efforts to deliver the first batch of units up to 1,000 vehicles with an agreement with the state of Oklahoma. Now, it's very important, this up to 1,000 units caveat, because one very common strategy for EV industry is to attract attention through grand announcements, even if the actual deliveries may fall very short to this. So to strengthen the financial standing, Canoo has decided to raise more money using, preferred stocks and warrant subscription. It's crucial to understand this because despite securing over $1 billion from investors so far, the company is very tight for cash. So an injection of capital is very necessary, and on September the 30th, they did so with an additional injection of around $53 million. Meanwhile, the Canoo stock has experienced a 98.63% drop from the 2021 peak, and in the most recent quarter, the company had a burn rate of $61 or $62 million per quarter, which is a very significant improvement, of course, from the lowest point when losses reached around $120 million per quarter. But the upcoming quarters are going to be very crucial for Canoo as it prepares for increased sales, aiming to mitigate the cash outflows. So what's kind of sort of exciting about Canoo is the projection of revenue growth. So the current estimates suggest a minimum revenue back in 2023. And in 2024, we're supposed to see $268 million with $1.25 billion in 2025. And if the whole thing is realized, these figures could position Canoo as an attractive investment. However, the journey to those targets isn't without risks, given the challenges faced by many new EV companies in production and deliveries. Despite optimistic revenue forecasts, analysts anticipate a loss of 41 cents per share in 2024. Now, this is an improvement from the 2023 20 cents per share loss, and the gross margin should be around 4.4% in fiscal 2025. So they're trying to go there. They're trying to step towards profitability. But seeing where things are at the moment, Canoo is still in very early stages requiring patience as it navigates the complexities of EV industry and its relation with the macroeconomics. The primary question at this juncture to ask, well, actually, there are two. One, if the market is patient enough, and two, has Canoo reached like a bottom from which it's going to bounce back from? Now, if we look at Canoo's share price, neither seems to be really the case. Like, one, the market doesn't seem to be too patient with it. It doesn't seem to be sending a message that says, hey, you know what? We're comfortable with you losing money quarter after quarter and to eventually reach the stage of break even and even profitability. That's the first one. And the second one is its price doesn't seem to have reached a bottom just yet. Like, we really have to see that it actually bounces back from like the 20 cents or the 21 cents level in order for us to be like, oh, okay, you know what? Yeah, I'm going back. I'm not seeing this kind of movement at the moment just yet. So with that being said, here's a quick look at the technicals. The trading volume is around 72 million shares at the moment, with an average volume of 54 million shares. Over the 52 weeks period, the price fluctuated between 21 cents, so now, and $1.47. The volume of shares traded tells us how many shares are being bought and sold at any given point in the market, and if there's enough liquidity to support a trading strategy. If the float is too thin, it's going to be easy to push it around, but the low liquidity could mean that the demand is limited as well. When we compare the current volume against the average volume, there might be the possibility for trend reversal or breakthrough should the difference be too large. For instance, if the stock were to break through, the current volume would be significantly higher than the average volume. The market cap of Canoo is currently around $154 million. As we compare the current price to the historical price fluctuations, the stock is 6% higher than the 1-month low, 6% higher than the 3-month low, and 6% higher than the 52 weeks low. On the options market, which often gives us a hint on the market sentiment about where things are going to go next, the implied volatility is currently around 230% compared to a historical volatility of 94%. The put-call volume ratio is currently at around 31%. It is normal for most stocks to also tend to have a higher put option volume than what they deserve, because many institutional investors hedge their long positions by buying out put options. The most recent volume of options traded is around 3.8 thousand contracts a day versus the 30-day average of 4.7 thousands. Regarding the open interest, the most recent volume of open interest has been 464,000 contracts versus the 30-day average of 442,000 contracts. Regarding the shareholder structure, institutional shareholders own 11% of the outstanding shares. The biggest shareholders include Vanguard, BlackRock, and Citigroup. Typically, it's best to see some institutional participation when holding a stock for the long term because it offers a layer of stability and a token of reliability in the medium to long term. It means that the market is confident that it will deliver value in the long run, which is an important factor to consider for investors. I personally consider the minimum threshold to be around 30% of institutional ownership. The current short interest is around 19% of the total float, and 44% of them come out from the dark pools. Typically, if the short interest is above 15% of the total volume, with a lot of it from the dark pools, we could say or argue that there's institutional presence in the short operation, and there may lead to be like a short squeeze. However, in this case, even if that's not the case, I wouldn't be surprised. I wouldn't be surprised because I think that just organically speaking, there's enough people who think that Canoo might not be the best stock to stay around. Like there's significant solvency risks. So it's not surprising to see a lot of people who just want to short it. So I wouldn't say that in this case there's much of an argument for short squeeze. So right now, the global markets are facing a complex interplay of factors that have the potential to significantly influence the equities worldwide. In this speculative analysis, I believe that the consequences of the global inflation, surging commodity prices, and decline quantitative easing, as well as the rise of inflation rates or interest rates, plus the geopolitical instabilities, are going to play a significant part. The increasing inflation rate has been putting pressures across the globe, threatening the purchasing power, raising the input costs, and impacting corporate profitability. Companies operating internationally may face challenges in managing rising production costs and also to sustain profit margins. Those dynamics could trigger market volatility as investors adjust their risk return expectations. The upward trajectory of commodity prices, including energy, metals, agricultural products, have been having far reaching implications for various sectors of the global equities market. The companies heavily dependent on these commodities may experience squeezed profit margins, potentially affecting stock valuations and investor sentiment. The reduction or the end of QE's quantitative easing measures by the central banks worldwide may have resulted in reduced market liquidity. So this in turn could lead to higher borrowing costs for companies seeking capital, which may also discourage investment activities or will. The elevated market volatility plus the reduced investors' appetite may also continue to occur. Now, the central banks around the world are tackling this delicate situation of balancing the inflation rates with the economic stability and, if possible, growth. Central banks opted for aggressive interest rate hikes to combat inflations. Borrowing costs for companies have been rising, which has also slowed down business activities and also fueling the market's volatility in terms of the equity prices. Now, ongoing geopolitical tensions, including trade disputes, political uncertainties, and social unrests, will inject an additional element of volatility into the global markets. Investors may adopt a cautious approach, shifting towards safer assets, impacting the equities. Additionally, the escalating conflicts may disrupt supply chains, negatively impacting the performance of international companies. Given the interconnectedness of global markets, the aforementioned factors have reverberating effects on the US equities market. Companies with significant exposure to international market may face a lot of headwinds resulting from the economic slowdowns, disrupting the supply chains and the currency fluctuations. But nevertheless, the US market is known for its resilience, and the diverse sectors may attract investors seeking safe havens. So really, the current landscape is characterized by global inflation, surging commodity prices, reduced quantitative easing, rising central bank inflation rates, geopolitical instabilities, and also ongoing lack of certainty regarding growth. While the US market may exhibit relative strength due to the safe haven status, it's going to remain interconnected with the global economic landscape. For long-term investors, these conditions may offer opportunities to identify undervalued companies with strong fundamentals and international diversification. With that being said, short-term trades should be approached with caution because of the increased volatility and uncertainty. And also, we should be careful when assessing individual companies, sectors, or regions. So, my conclusion about GOEV or Canoo after all this is that while there might be valid reasons to explore Canoo about like whether it has a place in your portfolio, for example, as a very marginalized position, like aiming for moonshots. But overall, the stock is not for most portfolios if the goal is to have a suitable long term exposure in EV. So, if you're aiming to have like a very limited and speculative exposure to the EV market, Canoo could potentially fit the bill. But if you're seeking like a safer and more enduring investment, I would say that there are many other better options in the market that do deserve your consideration. I would recommend to commit maximum between 0.5 to 1% of your portfolio in Canoo, and obviously split the allocation in batches of 20% or less over at least 6 months so that you can smooth out any sort of pullbacks and further retracements.